At this very moment, institutional trading desks across the market are currently defined by a single, overwhelming, and measurable emotion: panic. Since January 2026, the Nifty has plunged from a peak of 26,373 down to 22,930. That is a steep 13% contraction, compressed into exactly 2.5 months. This velocity has entirely erased the complacency of the previous cycle. The sentiment we are seeing now maps directly to a mathematically quantifiable state of exhaustion. This composite fear and greed index shows exactly how deep that exhaustion runs. The needle sits at negative 2.7, locking the market firmly into extreme fear territory. Look at the internal components on this dashboard. The pessimism is being driven almost entirely by deteriorating price strength, which sits at negative 2.0, and fading momentum at negative 1.2. While the retail crowd treats extreme fear as a signal to flee, the underlying algorithm notes a different trend. These components are showing modest improvements from prior readings, suggesting the panic is stabilizing. Institutional allocators treat this data as the analytical starting point to hunt for mispriced equity. There is a persistent paradox in professional capital allocation. The exact moment the market feels the most dangerous usually coincides with the lowest actual forward-looking risk. When a portfolio takes a 13% hit, going to cash feels like the responsible, defensive choice. Yet historical base rates demand the opposite. This is when aggressive accumulation is mathematically required. To act on that requirement, you have to look past the surface volatility and locate the mathematical floor holding the market up. You don't find that floor by looking at the current drop in isolation. You find it by matching the exact quantitative signature of the sell-off against historical drawdown regimes. Stripping away the emotional weight of a correction and classifying its mechanical nature allows us to isolate the long-term investment premium that the panic is currently obscuring. Market corrections fall into a specific historical typology based on their underlying macro triggers. Decades of data reveal three distinct market shocks: event, structural, and liquidity. Event shocks like 1990 or 2020 average a 34% drawdown but resolve quickly with a 5-month V-shaped recovery. Structural shocks like 1992 and 2000 average a destructive 53% drop. Systemic issues like domestic earnings, failures, and weak governance drive these declines. Because they require a multi-year earnings reset, they take an average of 16 months just to locate a bottom. Finally, we have liquidity shocks, the corrections of 1994, 2006, and 2021. These are driven by mechanical capital flight. The primary culprits are heavy outflows from foreign institutional investors and sharp sell-offs in rate-sensitive sectors. When global credit lines seize up, capital drains from the system, forcing mechanical selling regardless of underlying company fundamentals. For a liquidity shock, the rebound is significant. While drawdowns average 36%, the 12-month forward return averages over 61%. Correctly distinguishing a permanent structural impairment from a temporary liquidity vacuum is the single most vital task for any capital allocator. Analyzing the January to March 2026 contraction through this specific historical lens reveals how the current cycle should be classified. The initial data points towards a liquidity shock, carrying a mild structural overlay. This classification begins with the internal regime composite. The score currently sits at 40.0, placing the market squarely in a correction phase rather than a full systemic breakdown. The market has already mathematically absorbed visible headwinds, accounting for a higher for longer Fed rate, decelerating earnings growth, and institutional outflows. By contrast, current valuations ignore impending catalysts like a Fed rate cut cycle, consumption spikes, and the return of foreign capital. Because trading desks are hyper-focused on the immediate liquidity drain, they are treating these upcoming structural catalysts as though they have zero probability of occurring. With the known constraints already baked into the 13% drop, the market possesses massive asymmetric upside the moment any of these unpriced catalysts materialize. To find the exact mathematical flow where that upside begins, we have to move from macro theory down to the internal mechanics of the exchange. This is a breadth analysis chart of the Nifty 500. It measures the percentage of stocks trading above their respective moving averages, showing the extent of the internal damage. Look closely at the top pane, which tracks the short-term 20 days simple moving average. The current reading is severely depressed, only 14%. While deeply oversold breadth does not guarantee an immediate pivot, it mathematically confirms we have entered a value zone historically primed for heavy accumulation. Synthesizing these data tracks reveals a sentiment of extreme fear, overlaid directly onto a mathematically defined liquidity shock. The primary external weight driving this fear remains global central bank posturing and the anxiety surrounding the Federal Reserve's rate path. Yet, the historical base rate for this specific market regime is an average 12-month forward return of nearly 62%. Treating a temporary capital drain as a permanent structural collapse causes professionals to liquidate equity at the exact numerical threshold where they should be buying it. This extreme fear is simply a mispricing of volatility. It has created a temporary measurable discount on high-quality domestic assets. This dictates a very clear strategic mandate for long-term capital, navigating the rest of the 2026 contraction. Attempting to precisely time the absolute bottom of a volatile liquidity vacuum in this specific environment is historically futile. The actionable probability is clear. Progressively accumulating quality names during this phase of breadth compression offers superior risk-adjusted returns over the coming 12 months. The data proves the oldest rule in capital allocation. The best investments are made when confidence is scarce. Institutional pessimism provides the mechanical prerequisite for value creation, marking the optimal entry point for structural long-term positions.